On the minds of so many policymakers, investors, and people are rates and inflation. Can you give us a little bit of insight in terms of your views around where we're headed in Canada on rates, both in the short term and the long term?
I'll make the call for both Canada and the US. So I'm hopeful that the policy rate will settle at just under 4% on both sides of the border. My personal view is that when all the central banks are now doing this most synchronized tightening cycle that we've seen in many, many years, as everyone is draining the global economic pool at the same time, surely the water level is coming down much faster than what your normal models would suggest. So under these circumstances, I think 4% would be, just under 4% would be a nice point, given the fact also that we're seeing significant deceleration in inflation. We're seeing it in Canada. As of this morning, the 3-month annualized rate on headline CPI inflation is at 2.9%. It's actually below the overnight rate from the BOC. So I think the central bank should pause after all they've done and assess the situation, because the global economy is about to slow dramatically and inflation is a lagging indicator on the cycle.
So, Earl, what are your views in terms of the long term? Stéfane was just talking about the short term now with the CPI numbers coming out today, but what are your longer term views of where we're going to end up in terms of rates?
Yeah, I think this time it's important to distinguish between the destination and the path. I largely agree with Stéfane in regards to destination for the end of this year, 4% and a pause. I mean the path along the destination, but this destination is a secular change in environments. The last 40 years we had lower volatility, lower inflation, lower interest rates. It buoyed all risk assets. Right now, we're in a market environment of higher volatility, higher inflation, higher interest rates. The interesting thing is the last time we were in this regime was 1965 to 1982, 17 years. We've only been 17 months of inflation right now, literally in Canada. So, I think that the destination's a lot higher than 4% because of the secular change that we're undergoing. I think it'll be 6% at the end of next year, 4% end of this year, pause, and then 6% end next year, and then we'll reevaluate.
So essentially, if I'm hearing you right, Stéfane, you're advising that we're getting to a point where the central bank should pause, but Earl, you're thinking that they are going to go further.
Yes, and the reason is there's two ways that you get to a recession. One is the higher rates ways that everyone's scared of and the type of recession it will bring, because higher rates, lower growth, lower demand, lower inflation is the plan. The other way you get to a recession is you stop raising interest rates and you get higher inflation. When you get higher inflation, you get what they call demand destruction. So people can't buy other goods other than food and gas. And then you go into recession. Politicians, central bankers would prefer to get to a recession through higher rates rather than demand destruction. Why? Because there's more optionality. If you raise rates high enough, let's call it 6%, you break the back of inflation, and then you know what? You could lower interest rates. You could increase spending. Otherwise, everything that you do otherwise, lowering interest rates, increasing spending, increases inflation if you don't break the back of it. And that just ends up in a worst case scenario. So that's why it's important to distinguish between what's the long-term destination and the path. And I think that gives you a full context in the environment that we're in.
So Stéfane, let me bring you in there, because we've been talking about that R word, recession, and Canada's job market has clearly been slowing. Even the report this month showed that those higher interest rates that have already been put into effect are causing the job market to slow. So what is your thought in terms of how close we might be to a recession, and how bad could it be?
I think a recession is a policy mistake. If you engineer by over-hiking interest rates, you're causing state of disarray in labor markets. And I don't think that's palatable to politicians. So I actually believe they will be forced to cut rates next year as labor markets start to slow down, as corporations need to make their budgets for next year. And what we've seen in both Canada and the US in recent months is there's no growth in full-time jobs. So the little growth that we've seen in employment, and in the US it's been better, much better than expected, but it's all part-time jobs. Corporations are looking at the next year and they're saying, why should we hire these expensive full-time workers when we're not sure about the global economic outlook, with all these central banks that are threatening to push the global economy on the breach of recession. So my view is that if they are to raise interest rates above 4%, then they will create this state of disarray in labor markets. And that's a policy mistake, in my opinion, because there's still 50% of inflation that is caused by supply chain issues. Recall that the Chinese economy is not fully reopened. We're still facing the supply shock from Ukraine and Russia. There's just very little control that you have in terms of monetary policy. So I think the supply component of inflation still plays a very big role on what the numbers that we're seeing right now. And that's why the central banks have to be careful.
So we've talked about supply chains, as you mentioned, and demand destruction, as you mentioned, Earl. One thing that certainly I know people in Canada and investors are looking at closely, both in Canada and the US, really, is housing. So can you talk a little bit, maybe Earl, we'll start with you. Where do you see the housing market playing into how the economy does going forward?
Yeah, I do see the housing market declining further. But there's a good and bad about it. It's a good reason for declining. So when we saw the housing market decline significantly in 2007 global financial crisis, that was because the banks stopped lending. There was a leverage issue. They had to get their leverage back on board. They stopped lending. Right now, banks are still lending. And that is the key thing. That is the multiplier. That is the oil that keeps the economy going. Having said that, the requirements for lending are significantly higher in regards to how much loans people are eligible for. And that decline in regards to the loan amount or the mortgage amount that people are eligible for is being transferred directly into housing. The good thing about that, in regards to the housing prices coming down, the good thing about that, this is transferring wealth, in my mind, from the sellers of houses to the buyers. And I think that puts us on a much better footing going forward because they're paying the same mortgage. They're getting less total amount, but they're buying the same house. And they have the potential capital appreciation lower down the lines. So I think housing will come down probably another 20%, fairly significant. But because the banks are in good state, I believe, it's not going to be a housing crash. It'll be a deep correction and a necessary correction. So although I see the housing market coming down, I am optimistic. What you have to watch out for when you look at the economy is what are the implications of the housing market on business investing. Usually people look at housing market as a leading indicator of business investing. That is the key thing to what level of recession that we'll get is how much does business investment change. Thank you.
So Stéfane, I'll toss that over to you. What are your views in terms of the housing market? And as Earl just mentioned, how it may intersect with that supply and demand you were talking about, or supply chains you were talking about, that has really impacted the construction market, the building of homes, the getting enough appliances into people's homes?
It's an interesting question because you have to make a difference between home resale activity and the housing starts or home construction. And I think Canada is in a special place. If you use home prices, if you use the Terranet National Bank Index, which is similar to the Case-Shiller in the US, prices are down 4%. I agree with Earl that prices will continue to fall. We have a 10% downside on home price inflation in our forecast, or not home prices, down 10% in our forecast. Now that would bring you back to where prices were back in 2021. So it's not a massive downturn. I think it's manageable, and the reason why, and we also have resale activity that's already down 30% or so. So prices are coming down 4% from peak, going down to 10% in our view. Why they don't go down lower than that, and why we don't have a collapse in home starts, and that's important because that's your multiplier effect on GDP, is because of household formation in Canada, which is dramatically different from any other G7 economies, through a very aggressive immigration policy. We have our population age 25 to 54 growing at 220,000 people a year right now, which is the biggest increase since 1993. So that's household demand. So while we do recognize that home resale activity is coming down, the home starts are likely to remain relatively stable at 100, maybe at 170,000 units a year, which is pretty high level, which is a reflection of this demand for household formation. So, and that's the multiplier effect on your GDP. That's what keeps home construction activity at the decent level enough that you might avert a recession in Canada. So again, big it's important to distinguish between home resale activity, which is down significantly with home starts, and the overall immigration policy that is creating this tremendous demand for household formation. So I'm not too pessimistic about the housing market in Canada. It's a totally different situation than the US was back in 2006, 2007.
Earl, I just want to bring you in there because Canada's immigration policy has differed somewhat from the US and has obviously impacted the economy in different ways. What's your thoughts going forward on how that may bolster or not the economy?
Yeah, I think it's a very strong, it's probably the strongest point that Canada has. You know, not only is the immigration policy pretty good and pretty open, but you're bringing in a very highly educated population here that's able to immediately contribute to the economy. So that will definitely buoy house prices. So I agree with Stéfane. I think we're in good shape on the housing front. The external factor, so to speak, that could accelerate things on the downside is how bad a recession do you get, right? Because housing here is supported by employment. You know, so if you really get a drop off in employment, how do you have the income to pay for mortgages? How do you have that demand? So I don't think housing's out of the woods. I think we're in a best case scenario compared to the US and where we stand at this point in time. But if we do have a medium to hard recession in Canada, I would anticipate further pressure on housing. And my expectation is that we do get a hard recession in Canada, actually, tell you the truth. But it's not until 2024. So that's why I'm slightly more negative on housing, but it won't be a crash.
So, Earl, just to make sure the viewers and listeners heard that correctly, you are expecting a potential for a hard recession in Canada, but not till 2024?
Yes. I think next year we'll talk about soft and medium. And part of the reason why is the excess savings that were accumulated during the COVID pandemic. That will help. It's a delayed function in regards to the impact on the economy. The reason why I think we're going to have a hard recession here and a medium to hard in the US is when you look in history, a comparable time now in regards to high inflation, low unemployment is 1973, 1974. And what history has told it in the US and what history has told us about that session is because employment stayed so low for so long, because employers were scared to fire people, they wanted to hire to stay competitive because they saw the demand at the time. It ended up being a worse recession than it would have been because while earnings were getting compressed because of inflation and less demand, they were still hiring. And not only were they hiring and keeping people employed, they were increasing salaries, right? Because you needed to keep the real salary rate high. And what happened was because they waited too long, they weren't able to survive when the recession truly hit. We are in a comparable state now when you look at the level of unemployment, both Canada and US, and look at the level of inflation. I think it delays the hard decisions that must be made by businesses, which will probably be made at the end of next year, which will lead to that hard recession in 2024. And that will lead to an ongoing continuation of housing decline prices.
So, Stéfane, we talked at the beginning about rates and inflations, and in many ways, the central banks in the US and Canada have been somewhat similar in tandem in terms of their processes for raising rates. Where do you see the US and Canada going for more broadly, economically? Do you see a big divergence starting to happen when we talk about the strength of the economies in the US or Canada, or do you think they'll stay in somewhat of a parallel track?
Well, again, my forecast, I have, interest rates stopping at just below 4%. So, the growth forecast might be a little bit different than what Earl has. The reason I have that forecast because I have inflation coming down quite significantly in the coming months. We're starting the year. We will start 2023 at below 5%, I think, on both sides of the border. Just to come back to the 1970s, I think one of the biggest difference was the demographics versus what we have now. Even though inflation might be similar at this point in time, back in the 1970s, you had a ratio of 2.3 young workers per older workers. So if you have more young workers, it means more demand for goods and services. So your inflation expectations might be get more ingrained. That ratio is now is below 1 in the US. So there's more older workers who are now settled, don't have to purchase all these services and goods that we saw back in 1970. So I think this is where the demographics might actually help to bring inflation down. And again, I stress my point that there's supply components that are still very much important on the inflation front, which we'll discover together in the coming quarters. So if we are right that inflation is below 5% by the start of the year, then that makes for a growth path that is certainly more favorable both for labor markets and also in terms of protecting the overall economy going into 2023 and 2024. So we have growth at around 1%. That is significantly below potential. You can bring inflation down by having growth below potential. Again, my view is that if we are to incur a recession, it's a policy mistake by central banks that are trying to correct a policy mistake by making another policy mistake by overreacting on inflation, which might come down quite significantly in the coming months. And we're seeing it on the Canadian numbers this morning. Yes, headline is at 7%, but the 3-month rate is below 4%. That's a great improvement.
So, Stéfane, if I heard you correctly, do you think one of the biggest risks to your forecast is that central bank policymakers, overcompensate? They make a mistake and then they overcompensate with another move that can be too large or I guess arguably too small.
I think Earl will agree. I mean, we're doing a policy rate. We're making a decision on a lagging indicator, which is inflation. So you have to be right on your inflation forecast to call the policy rate properly. And yes, there's great uncertainty on making that inflation call, right, Earl?
There is greater uncertainty on making the inflation rate call, but what's interesting is I don't see it as a policy mistake. I see it as a policy intent. The intent is to get into a recession. They don't call it a business line. You don't stay above growth or above trend growth forever or at trend growth. They call it a business cycle. And the reason why they call that is because of inflation. Inflation destroys capital formation. It destroys individual demand. There's a lot of bad things with inflation that the central banks are all on top of, and which is why they're all raising rates right now. But there could very definitely be a policy mistake. I don't disagree with that. There's a lot of volatility in the market.
So on that point, Earl, we just have a couple minutes left. There could be and is likely to be a lot more volatility forward because of all the issues that we've talked about today. Where does the housing market go? Where does the job market go? Do central bankers, raise rates and then pause when it's appropriate, or do they overshoot? So when you think about the minds of investors, what's one thing, I'll start with you, Earl, that you think they should keep in mind during this tumultuous period going forward? And then Stéfane, I'll come to you.
Yeah, the important thing now, when you hear opposing views from people who have strong arguments that back it up on both sides, what that equals in the market's volatility. And you know what? The odds are probably both Stéfane and myself will be right at some point in time. So from an investor's perspective, our position is to take advantage of that. You have to move from a portion of your portfolio from passive management to active management, because I'll use an analogy here. Passive management is like the equivalent of being in a sailboat where the winds are blowing one way. And we've seen that for the past 40 years. And they're blowing you towards the white sand beaches of the Caribbean, which is all good. Right now, because of increasing volatility, increasing inflation, we're getting a lot of cross currents, crosswinds. So you can't be in that sailboat because they'll blow you into the rocks, they'll blow you into the cliffs before you get into the white sand. You got to be in a rowboat. And that rowboat is active management. And then you could go with the winds, against the winds, and we'll get to that destination and we'll get there safely and soundly and be able to take advantage of the winds at hand.
And Stéfane, your thoughts?
In a world of food and energy insecurity that is likely to last for a very long time, I think Canada's a pretty good place to be when you consider our demographics at the same time. So as Earl was saying, you want to be more active management when you choose a geographical situation, and maybe Canada is probably a way to play defense in this uncertain world that Earl was alluding to.